Hey guys, this is the last part of the three-part lecture on tax basics. I'm going to focus on taxable income in part 3. So let's do a quick recap on AGI and adjustment deduction, which I cover in part 2. So first, adjustment deductions lower your AGI, and business expenses are one of the most powerful adjustment deduction that you can create. Your AGI determines whether you get free money like tax credit and also whether you can qualify for additional above the line deduction like student loan interest payment deduction. So now let's talk about the king of 1040 anatomy. That is taxable income. Why do I call it the king? Because taxable income is what determines your tax bill. That's right. If you lower your taxable income, you'll owe less to the government. That's simple, right? Duh. So again, one of the main purpose of the tax planning is do all that is legally allowed to lower your taxable income. So let's take a look at the 1040 anatomy again. Based on this formula, what actually lowers your taxable income? What's right here? Any guess? If you said standard or itemized deduction, you would be correct. And this is also called below the line deduction. Remember the imaginary schizophrenic, the line that we talked about in part 2 that sits right across adjusted gross income? That's right. Because this deduction is below that imaginary line, it's called below the line deduction. And below the line deduction, this guy is what reduce your AGI further down to taxable income. Here's where things get a little bit tricky. You don't get to take both standard deduction and itemized deduction. It's one or the other. You get to choose one. Typically, whichever gives you a larger deduction. So let's talk about each type and how to determine which one to use. We're going to start with the standard deduction because it's the most common type of below the line deduction and most likely one that you guys are using. So standard deduction is available to everyone. It's kind of default. The amount is based on your filing status, whether you're single or married filing joint, for example. So since Dr. Kimchi is single, her standard deduction amount is $14,600 for 2024. If you're married filing joint, her standard deduction will double, $29,200, double the single amount. So let's talk about itemized deduction, which is way, way, way more complicated. Headache-inducing, almost. So itemized deductions are made up of 6 different categories. When you add up all of these 6 categories together, you get the total itemized deduction amount. Here's where things get really tricky. Each category has its own limitations and different method to calculate to determine what portion of the expense, how much of the expense is actually deductible. So for medical and dental expense category, even if you spend 10 grand on medical expenses, not all of them will count as a deductible medical expense under itemized deduction. The amount that is deductible would depend on your AGI. So fully understanding all nuances would take more than a full lecture. So what's important to know for now is this. Each category has its own rules and limitations and different way to calculate deductible portion, which I'll hopefully cover in a future lecture in detail. So in my opinion, category 3, personal interest category, is going to be most relevant to you guys. So if you have a mortgage payment the interest portion of the mortgage payment, not the principal, interest portion of that payment counts as a personal interest, but within a limitation. And a certain portion of it is deductible. So typically, if you have a mortgage on a house in an expensive area, like in California, you would typically qualify for itemized deduction. So let's take a look at Dr. Kimbap and Dr. Kimchi and how they did when it comes to below the line deduction. Dr. Kimbap, who did not own a house, he took standard deduction. Generally, if you don't own a house, your itemized deduction will be very minimal, so most people in that situation will take standard deduction. On the other hand, Dr. Kimchi knew that mortgage interest payment would tip her over into itemized territory. So after she sold her COVID-era house for $250,000 of gain, she bought another one. So in 2024, she paid $50,000 in mortgage interest. And when she added up all of the 6 categories, including state and local taxes, her itemized deduction came out to be $60,000. Since Dr. Kimbap took standard deduction, his taxable income came out to be $56,000, and his federal income tax bill was close to $7,500. Meanwhile, Dr. Kimchi was able to take $60,000 in itemized deduction, which reduced her taxable income to just $11,000. As a result, her tax bill was only just over $1,000. So as a result, Dr. Kimchi paid roughly $6,000 less in federal income tax compared to her brother, because Dr. Kimchi understood how below the line deduction worked. She took full advantage of it. So you've ever wonder what people meant when they say, hey, buy a house to save on taxes. This is exactly how you save on taxes. When you buy a house, it's a mortgage interest payment portion is what gives you the below the line deduction, and that's what gets you the tax benefit by lowering your taxable income. And here's where you'll find the below the line deduction, line 12 on page 1 of your 1040. When you apply this below the line deduction to your adjusted gross income, then you arrive at the total taxable income, which shows up on line 15. So now you know how to determine your taxable income. Let's talk about how to calculate your tax bill. So IRS uses progressive taxation system, which means the more money you make, higher your tax rate is going to be. More money, more problems, right? So every year IRS publishes an update, a federal income tax table, which is based on your filing status like single and married filing joint. So let's take a look. Let's apply this to Dr. Kimchi's taxable income. Let's just assume that her taxable income is $60,000. So first, $11,600 of her taxable income is going to get taxed at 10%. The next roughly $35,000 of her taxable income is taxed at 12%. And then the remaining roughly about $13,000 will be taxed at 22%. When you add up all this tax bills up, then your federal income tax bill is going to be roughly $8,200. So that means if she earns additional dollar, the dollar will get taxed at 22%, meaning she's going to pay 22 cents in federal income tax on that dollar. On the flip side, if she finds a way through a strategy to reduce her taxable income by $1, she's going to save 22 cents in taxes, federal income tax, until her tax bracket drops down to the lower 12% bracket. So that means any tax planning strategy that lowers her taxable income effectively gives her 22% return on investment. So now, when you start making a big dollars as a interventional radiologist or plastic surgeon, you're going to be likely sitting at 37% tax bracket, right? So that means every extra dollar that you can deduct to lower your taxable income will save you 37 cents in taxes. So think about that. That's 37% return just for knowing how to use the tax code. So the higher your income, the more valuable it becomes to understand, to know the rules and apply smart tax strategies. That's how you keep more of your money in your pocket and less to Uncle Sam. So let's do a quick recap on below the line deduction and taxable income. So first, below the line deduction are what lowers your taxable income. And when you have mortgage interest payment, you could itemize deduction instead of taking standard deduction. And finally, taxable income is what determines your tax bill. So let's do a final recap to determine who won, Dr. Kimbap or Dr. Kimchi. So in the left corner of the ring, we have Dr. Kimbap, who did not understand Section 121 home sale gain exclusion rule. As a result, he ended up paying $60,000 in capital gains taxes on $250,000 of the gain from the sale of his house. With no tax planning in place, he had no above the line deduction. Only below the line deduction was standard deduction, which was $14,600, which is a minimum that a single person get, everyone. So as a result, his taxable tax bill on his income was $7,500. In total, he paid nearly $68,000 in taxes. It's a lot. In the right corner, we have Dr. Kimchi. She made $250,000 of gain from sale of her house, but that gain was tax-free because she knew the rule and planned ahead. With smart strategy, she also created $17,500 in above the line deduction, and thanks to her mortgage interest, she was able to itemize $60,000 in below the line deduction. As a result, her final income tax bill was just over $1,000. In the showdown of Dr. Kimchi and Dr. Kimbap, the difference came out to be whopping $66,000 in tax savings. So one can safely conclude that Dr. Kimchi won the match by a landslide. So let me leave you guys with the final take-home points. It's very important to understand and even memorize the 1040 anatomy. It's foundational to everything in individual taxation, in my opinion. So it starts with your gross income, which becomes adjusted gross income via above the line deduction, and AGI becomes taxable income via below the line deduction. Remember, taxable income is what determines your final tax bill. And side gigs like moonlighting can help you create legitimate above the line deductions by incurring business expenses, which in turn lowers your AGI. And reducing your adjusted gross income doesn't just lower your taxable income, it can also unlock more tax credits and additional deduction. So with smart tax planning, you can even turn a trip into to your favorite vacation destination spot, into a legitimate business deduction, all while enjoying yourself a little bit, staying up to date on the newest development related to your medical practice. And you can do that by understanding the rules and planning strategically and documenting everything properly. So keep this in mind as you grow in your career and as your income explodes upward. Because Uncle Kenny Kim wants you to win. Happy tax learning. Hope this was therapeutic, and I see you guys next time.